We're going to start with Nicolas because we're behind schedule and he has another commitment at the World Bank. He is co-founder and director general of the World Pensions Council, and I have a specific question for Nicolas, and that is, given the role of the World Pension Council and the research that you all have been conducting, what do you think needs to specifically happen from a legal and financial perspective to activate pension fund investment, as well as the utilization of central bank reserves into large-scale infrastructure projects? And what specifically can the World Bank Group do to assist with that mobilization? Nicolas.
Thank you, Barbara. First of all, I want to put things into perspective and ask you for a short while to put yourself in the shoes of these Canadian, Australian, and US pension funds who are starting to invest in infrastructure domestically or in Europe and progressively into emerging markets and frontier markets. And most African nations would qualify as frontier markets. So the way they view the world is kind of, you could say, biased because of benchmarks and indices. And this is the way things are. They tend to slice the world into regions and then tend to slice investment into what they call asset classes. And their worldview, to a large extent, is formed, and some may say deformed, by the indices. And so let's take the main investment index, which is the MSCI World. If you look at the MSCI World, the whole of Africa, I think, is less than 1% or 0.9% of the MSCI World Equity Index. And if you look at the population, Africa has 15% of the world population, so huge infrastructure needs. And demographics means that these needs are expanding. Africa has, I think, roughly all countries combined, I think 2.5 trillion GDP per annum. That's roughly 3% of the world GDP. And then, like I said, if you look at investment indices driving the way sovereign funds and pension funds view the world and put their money, Africa is less than 0.9% of that index. So you have a big bias. And you have another big bias inside the bias, is that if you look at that 0.9% Africa, which pension funds have on their map or on their radar screen, it is mostly, it's like 40% Nigeria, 20% Egypt, 15% Morocco, 10% Kenya, and all the rest of Africa is like 30%. So you can see many imbalances and many biases, and yet this is the way people or long-term asset owners view the world. And another element which is extremely important is country risk, because you may spend days doing, very advanced financial mathematics calculations using Excel spreadsheets. At the end of the day, the determining factor is really country risk, which to a large extent is a legal political risk first and foremost. So I would say that low regulation and political stability trumps finance and economics. So you may have a beautiful project if you do the discount cash flow, if you analyze the bankability or the whatever financial rationale of a project. On paper, it may look amazing, and you can do the math and prove it mathematically. But if there is a little bit of ownership insecurity, so if the legal system is too complicated, if long-term ownership rights are not viewed as sacred, and I'm using the word sacred on purpose, like this has to be by policymakers at the federal, provincial, municipal level, they have to worship property rights. If it's not viewed as sacred, as something which is really way high above, that you cannot tinker with, then all the rest will be lost. And so if you have one message to convey, is really that, ownership security. So when a government, be it at the local or national level, starts tinkering on the margin with that, it is disastrous. And it sends a very, very negative message, and that message will remain. So investors 5, 10, 15 years later will say, aha, in that country 15 years ago, that particular policymaker did that abrupt change in the legal environment. It's bad. it may happen again. So it's really, it has disastrous consequences. And one other key thing I would like, key idea I really wanted to convey to you today, it will come back. Yes, it's like that if you look at the balance sheet on the asset side of large pension funds and sovereign funds, today, at this very moment, infrastructure only represents 1.2 or 1.3% of their assets under management. Now, you have some exceptions, like Ontario, Quebec, the Dallas Municipal Workers Employees Pension Fund have a higher exposure to infrastructure. But on average, it's only 1.1%. It is time-consuming, and it is very illiquid. So when they want to put money in that asset class, they need to spend more time doing their homework and research than just going onto the stock market and buying shares, right? And so to justify going into an emerging or frontier market into a highly illiquid asset class, to them, there has to be a very strong investment case. They will not even, beyond country risk, they will not even waste or spend time considering it if there isn't a compelling investment case. So I started with a negative. Now I can switch to the most positive. Is that Africa has amazing potentialities, obviously, and because it's starting off a lower base, the gross metrics, the expected gross metric in the futures are really interesting, and this is why some sophisticated pension funds are starting to put Africa on the map. And infrastructure is a very interesting asset class because it's not only a financial asset class, it has to be financial. So it has to offer the proper kind of risk-reward metrics that an investor needs. So it has to be financially bankable and profitable from a purely cynical capitalist perspective. But infrastructure has many other attributes. And one of them is that they can act in a wonderful way as macroeconomic growth accelerator. So once you have modern highways, once you have modern rails connecting your nation to its neighbors or to a port or harbor, all of a sudden, macroeconomic growth is really incremented, and it can be hyperbolic. And so it has many positive long-term social consequences. And to just conclude that, I think, transportation is key, obviously. And, interstate transportation is really, really essential. And it takes political will. And I think the collective political view of infrastructure is changing for good. Not long time ago, people said the Washington consensus. And it meant, ultra free market, Reaganomics. And it meant being hostile to infrastructure. So like 10, 15, 20 years ago, at the end of the Cold War, the word infrastructure had become tinged with Marxist or Soviet connotations. It was bad, it was not good to spend money on infrastructure. That has changed. So basically, there is a new consensus in favor of massive infrastructure spending on both sides of the aisle. So we are reverting to an earlier era. If you look at the US or if you look at Washington, D.C. back in the 50s, in the days of President Eisenhower, infrastructure, the cornerstone of President Eisenhower's policy, yet he was a Republican, so he was a center-right Republican, but back in those days, it was perfectly kosher for a conservative Republican to say, yes, I think we need to spend trillions every year on infrastructure. Somewhere down the road, in the late 70s, early 80s, it changed, and it became bad to invest in infrastructure. That era of ultra-free market, Washington consensus, is changing. And if you look at Germany, for example, the macroeconomic figures that were published yesterday were a disaster. And one of the reasons why the figures published in Germany yesterday were a disaster is that that nation deliberately underinvested in infrastructure, notably in transportation infrastructure. The Germans, be they social democrats or conservatives, they chose deliberately on purpose to underinvest in infrastructure for the past 30 years because they thought it was bad. So they became stingy And so for the past 25 years, they invested on average 40 or 50% less than the OECD average, right? And they could afford to do it. Why? Because the investment cycles are extremely long. So if you want to be stingy as a government, if you want to stop all of a sudden putting billions every year into roads, highways, airport, it will not hurt you. So you can do it for 10, 15, 20 years, and your infra assets, they will age slowly. But after 20, 25 years of slow decline, then you're in trouble, and you have a series of bottlenecks. And so Germany is a very bad example. Unfortunately, another example is some regions in Canada and the US have also underinvested in infrastructure in the past 20, 25 years. And there's a National Association of US, so it's the National Association of US Civil Engineers and Architects. They have an annual, I think it's every 4 years, a quadrannual survey, and they gave a C- on average to US transportation infrastructure, and those doing the rating were US engineers from MIT or Caltech. So it tells you that it's bad to be stingy. It's good to invest in infrastructure. Obviously, you have Basel II, Basel II and Solvency II. It's difficult for the governments and for the insurance companies and for the banks. It's difficult to put as much money as they would like helping infrastructure projects, and this is why I think in the future there will be a bigger role for pension funds and sovereign funds acting jointly with them.
That was terrific. And because Nicolas has to leave in about 3 minutes, let me take the chair prerogative, ask a question, and see if anybody else wants to ask a question now so we get it. But the fact is, we have proven roadmaps for how pension funds can invest in infrastructure. For example, pooled finance facilities in the US have been used for over $40 billion, okay? Why aren't we doing that in Africa? We have one transaction, KREP, in Kenya, and with the support of the World Bank and USAID. Why aren't we scaling that up? We have monolines, and there is a monoline in the making. We'll see if it gets off the ground. That could be helpful. But of course, most of infrastructure in developed countries has been financed via monolines as finance. And of course, we have project finance. And I'm sure you'll talk about that later as a standard way to deal with the very issues that are prohibiting that. So I'd love to know if you have any thoughts about how we can adapt and refine and scale up those methods to do that. Is there another question quickly for Nicolas before he leaves? Yes, Ron.
In defense of the pension funds, the problem you face in investing in Africa is finally we're talking about small projects. You have to go in with an international agency. So what I think you need is, as Barbara suggests, is you need some big landmark projects which would, in a sense, break the dam that needs to be broken. Oh, sorry, Ron Leishing from MPG.
Nice to meet you.
Thank you. Another question before Nicolas wraps up? No?
Who's hiding?
Hewitt, Dan, South Africa investor. Nick, before you run, one of the other areas we hear a lot about is how to move domestic resources from within the continent that have sort of held offshore as reserves. And there's this classification which makes it very difficult for them to invest in illiquid assets. What are the practical things some of the central bank governors might consider if they want to repatriate and invest their offshore reserves or a portion of their offshore reserves in infrastructure investments within their own shores? Thank you.
Right, okay. All right. I agree with Barbara, and I agree with you. It's extremely complicated, and one solution would be to put in place some kind of platforms or pooled financing, be it on the debt. I think Barbara mentioned that earlier. So be it on the debt refinancing, mid to long term refinancing rollover platforms. So that would be more fixed income instruments, pooled instruments. But also conceivably, if you can get like a 50 or 40 years concession, that could be a pooled instrument to invest in equity infrastructure assets. So things are changing slowly but surely, and I think the World Bank is working right now, putting in place something called the Global Infrastructure Facility, GIF, and I think they will make some announcement in the coming days on that front. It's a very exciting project because it's backed by the World Bank, and they will start investing jointly or helping some of these asset owners. So that's pension funds, sovereign funds, pool their investment for mid-scale, maybe not the huge highway or rail, but for mid-scale to small-scale project, deliberately mid-scale and small-scale, and that's focusing on lower-income emerging nations and frontier markets. So a big chunk of these investments by pension funds, sovereign fund, jointly with the World Bank on that global infra facility, a big chunk of that money will be going to mid-scale projects in Africa, which I think is really a great idea. The whole world is moving slowly but surely. The Italians announced last month that they are putting in place something called Arpinge, which is basically a pooled pension investment platform, taking money from private sector, Italian pension fund, putting it to use into highways, railroads, mid-size to small infra assets. The Brits have been talking a lot for the past 3-4 years, and I think Prime Minister David Cameron delivered, 40 speeches on that topic in the past 3 years, but they have acted fairly slowly and have put together PIP, the Pension Infra Platform, which is not a big success, but they're only starting, so we need to see more time, we need to see where it goes. And then the Filipino government, very discreetly, and I guess it was amazing what they did because it's really off the radar screen. You don't read articles about that in the Wall Street Journal, but the Filipino government made a revolution 4 or 5 years ago. They decided that they would put their whole legal system on a very high level and make it totally compatible with private sector pension funds. And things are working because finally, after 4 or 5 years of effort, putting in place, ironclad property rights, very strong fiscal frameworks protecting the right of pension funds. And even if because the life of these projects may be 40, 50 years, down the road, when you sign a project today with the minister or the governor, everyone is a friend, but 10, 15 years later, another government comes into place, and then you're in trouble because you have a highly illiquid asset. You cannot sell your port or railroad overnight, and you're at the mercy of the local government because the local government is very often your client, your co-investor, and the judge of last resort. So it's like, if you're a foreign, pension fund with offices in Oklahoma City or Montreal, it's extremely dangerous and challenging to invest in such an illiquid asset in an exotic nation, quote unquote. And that's why the governments need to walk the extra mile to reassure pension investors. And the Filipinos have done it really superbly. And I think we really have to commend them for what they did. And they do it to the extent that they do roadshows that, when they go and visit pension funds in Ontario or California, half the Filipino government is in the room, and they do like professional, investment-style roadshows. And if you're a pension investor, that's very impressive. And I think governments need to do it. They need to walk the extra mile. Very quickly, to answer Hubert's question, it's a very important question, and it's a very strategic question, and there's no easy fix for that. So I would say to do what Hubert did is like basically to change the way central banks from emerging nations, the way their assets are measured or quantified by people here in Washington, D.C., or by people in Basel, in Switzerland, is very complex. It would involve some kind, I think, of I mean, it's not a very sexy world in the post Lehman Brothers era, but I think it would have to involve some kind of collateralization somehow, and it would have to be structured better than what we did collectively before 2008, because we failed miserably before 2008. But I think you can do smart, transparent, and efficient collateral frameworks that will allow, as Hubert hinted, these emerging market central banks to repatriate part of their short-term liquidity and make good use of them. You know, instead of the money sleeping at the bank, quote unquote, in Basel or Geneva, you could put part of it at work into highways and railroads, provided we had a good framework. And I guess this is what I wanted to convey to you guys today. Thank you for having me.
Well, please join me in thanking Nicolas for pushing the ball forward in very specific ways. Thank you.
Thank you. Thanks.
Doing business in Africa. You can't afford to be without Africa Investor.